the bottom 90%, the large section of the consumer, which is affected by by these forces. And we see that in two areas. One is manufacturing, which has been on a decline, and we see the consumer stress. So that let's now look into what is taking place on the monetary side. So the macro policy, right? There's one big beautiful bill act, or whatever it's called. So that's one side, that kind of fuels the corporate capital expenditure, offering tax advantages, etc. But then the other side is there is basically a monetary tsunami that can be expected during the year. So global money supply is expected to outpace sort of the nominal global GDP growth. So when money supply increases, it's creating basically a higher level of liquidity than what the market can absorb. So at Helix, what we tend to look at is how can we use that to our advantage? How can we weaponize that data? And how can we use that to deliver the superior returns that we deliver for our investors? So this update is going to talk through these areas. So deglobalization, or you want to call it multidimensional polarization as a trend that we see. The other side is this monetary impetus and sort of a monetary tsunami that is expected during the year, to the stock markets, to the global economy, and thereby what are we trying to do over here, right? So from an interest rate and sentiment sort of a perspective, the Fed's next meeting, late January, we expect sort of a no change sort of a decision. That's what the sort of consensus looks like. We also look at the prediction markets. So basically, in the UK, we have a prediction market for literally everything, right? So we want to predict the weather tomorrow morning. We bet on it, right? We are a country of betting for everything, right? So football scores, everything. The US is quite different, the way that works. So there's of a no change sort of a decision. So stay put, no change sort of a decision. While that Fed related monetary or policy pathway remains stable. Now there is a shifting risk premium at the back of this multidimensional polarization and the increased money supply that's now available. So now here is how I basically look at it, right? So we all understand behavioral economics. One side of us could say that we should be devoid of all sentiment, and then we should basically trade on the basis of data that's available. That would be foolish to do when you know that the markets are fueled by sentiment. It is fueled by emotions, right? So what does the fear and greed index from the CNN tell us? Is sitting at a point where it's going from neutral into greed, right? So 62.17 or whatever, 60, 62, 63 range. So it's basically saying that we are going into that greed stage, and a lot of this is down to that AI investment cycle and the oil investment cycle that's being triggered right now. So energy becomes one big. So it kind of hides the significant crowding in tech. I think we've talked about the tech, uh, risks quite a few times in these strategy updates, but I'll kind of repeat this. If you look at the S&P 500 right now, 35% is the Mag 7, the 7 tech stocks. And those are the ones that are, increasing in valuation. They have